Corporation loans to shareholders can be a useful financial tool, but they come with significant tax implications if not handled correctly. Understanding the rules is essential to avoid costly mistakes. When an S corporation and its shareholders exchange loans, the IRS has specific guidelines that must be followed. Failing to adhere to these rules can result in loans being reclassified as taxable income or distributions, triggering unexpected tax liabilities. The foundation of any legitimate S corporation loan is proper documentation. This includes creating a written promissory note with a fixed repayment schedule and an interest rate that meets IRS minimums. Where appropriate, collateral should be specified, and regular payments must be made according to the established terms. Without this documentation, the IRS may view the transaction as a dividend or compensation, leading to tax complications. S corporation loans to shareholders generally fall into two categories. Open account debt involves smaller, informal advances, typically under $25,000. These loans may lack formal written terms, but still face IRS scrutiny. Written debt instruments, on the other hand, are formalized with promissory notes and clear repayment terms. These are more likely to be respected by the IRS and support basis increases for shareholders, making them preferable for tax planning. It's important to monitor the balance of open account debt. If it exceeds $25,000 at year-end, the IRS may require it to be reclassified or formally documented. When a corporation needs funds quickly, shareholders often step in with personal loans. This can be beneficial when there isn't enough time to secure bank financing. However, repayment must be handled carefully to avoid tax consequences. If the S corporation passes through losses to owners, these can be deducted by shareholders up to the amount of their adjusted stock and loan basis. If pass-through losses exceed the shareholder's stock basis, the excess reduces the shareholder's loan basis, but never below zero. If the IRS determines a loan is not legitimate, it may reclassify the transaction as a constructive dividend, which is taxed as income to the shareholder without a corresponding deduction to the S corporation. Alternatively, it could be classified as compensation subject to payroll taxes if the shareholder provides services to the company. If reclassified as a capital contribution, repayments may not be deductible or returnable without tax impact. To prevent loan repayments from being considered income, shareholders should create formal notes for their debt when the company might be unable to repay or when pass-through losses are anticipated. This way, subsequent debt payments are treated as capital gains instead of regular income, resulting in lower tax rates. Another strategy is to delay repayment until a year, with positive net income to restore the loan basis. Several indicators help establish a loan as legitimate in the eyes of the IRS. These include a written agreement with repayment terms and interest payments at or above the applicable federal rate, a history of repaying prior loans, a reasonable debt-to-equity ratio, and clear intent to enforce the loan terms. The S corporation must act like a creditor, not an equity investor. When shareholders loan money to their S corporation, it can be advantageous when the business lacks credit history for external financing, when the shareholder wants to maintain their equity position without dilution, or when interest payments provide a return to the shareholder. However, tracking loan basis accurately is crucial, as repayments exceeding basis can be taxed. Properly structured shareholder loans offer valuable tax planning opportunities. They can increase basis, allowing for the deduction of S corporation losses. They can provide funds without triggering taxable dividends if structured correctly. And repayment of reduced basis loans may qualify for lower long-term capital gain tax rates. To summarize, loans between S corporations and shareholders must follow IRS guidelines, with formal documentation including promissory notes, stated interest, and clear repayment terms. These loans impact basis calculations and loss deductibility, requiring careful planning to maximize tax benefits. Proper documentation and adherence to loan terms are essential to avoid having the transaction reclassified as a taxable distribution or income. With thoughtful planning and proper execution, shareholder loans can be an effective financial tool for S corporations and their owners.